A rate cut from the Bank of England combines with some Q2 earnings surprises to create a mixed picture for European equities. Welcome to Market Insight, I'm Thomas Warner. The FTSE's real estate and home builder indices jumped more than 1% after the Bank of England's decision to cut rates. Shares in commercial banks moved the opposite way, and Q2 earnings from across the continent have also created some major winners and losers. With me to discuss Thursday's trading is Joachim Klement, Head of Strategy at Panmure Liberum. Joachim, a very warm welcome to you. What did you make of the reaction to today's rate cut?
Yeah, it was the anticipated rate cut with the anticipated reaction at the beginning, with interest rate sensitive sectors like home builders and small and mid caps jumping initially. But what was interesting to see that during the press conference, they gave back a lot of their gains as the Bank of England made sure to emphasize that it is in no hurry to do a second rate cut, and markets are now pricing in a second rate cut in November, but a very moderate pace going forward.
Well, we do know that they have to consider that there are public sector pay rises on their way. I know that's been weighing in the balance. We did see the ECB make their first cut and then sit back. So do you now expect that the Bank of England will do much the same thing?
Yes, it very much looks like the ECB and the Bank of England are going in lockstep, just in alternating months, with the ECB probably doing the next step and then the November rate cut by the bank. And even if you look into 2025, it looks like we're always getting one from one side of the channel and then from the other, while the Fed is a little bit less certain, but also at the moment looks like it is going to cut at least in September and possibly also in December.
Well, Joachim, let's turn to those earnings now, and it's Rolls-Royce leading the gains on the FTSE 100 and I think the Stock 600 today. Its shares are now at record highs. The CEO referred to a challenging supply chain environment. How confident are you that the business has actually turned a corner?
Oh, very, very confident. These results by Rolls-Royce were blowout results. And what was particularly interesting were three things. First, the big surprise to the upside came from the civil aviation unit and division, not from defense. The second thing was that cash flows are improving rapidly as working capital management has improved, which is the one thing that they have been struggling with in the last 2 years of their turnaround story. And finally, they basically had such optimistic guidance for the second half that it is almost inevitable that we will see over the next couple of weeks more forecast upgrades by analysts for Rolls-Royce. So this is really a very, very strong set of results.
Not such a cheerful morning over in Germany. We've had share price falls for VW and BMW today. They're both saying that they've been hit by low demand from China. It was much the same story from LVMH last week. Have European luxury names become too dependent on the Chinese market, Joachim?
It is definitely the case that anything that is very dependent on the Chinese market is suffering, whether that is luxury or whether it's the automotive sector. But we're now also seeing signs that this weakness from China is showing contagion towards Germany, where the German economy is slowing down. And that is then obviously a double whammy for the Volkswagen and BMWs at this point in time. Not only do they face weak demand from China, but increasingly so also declining margins in their European markets.
So overall, Joachim, how worried are you about European equities?
It is getting much, much worse than it was, say, 1 or 2 quarters ago. We are still in a phase where the European economy is recovering, but the weakness in Germany and in the German economy is becoming increasingly a headache. If you look at the earnings season for the second quarter so far, the interesting thing to observe are that revenues have missed estimates on average by about a percentage point, while earnings themselves have beaten consensus by about 5%, which is simply a reflection of companies now benefiting from cost-cutting measures that they announced earlier in the year. But what you can see if you look through sectors and companies is that the bigger the exposure to China and the bigger the exposure to Germany, the worse their outlook is. While anything that is focused on domestic markets in France, Italy, Spain is doing really well.
Joachim Klement, Head of Strategy at Panmure Liberum, thank you very much indeed for your thoughts today. And that is Market Insight. Don't forget you can watch more videos on Reuters.com.